This conference will now be recorded.
Good afternoon, ladies and gents, and welcome to LAT's weekly market insights. As this week draws to a close, there's been opportunities across the board, currency markets, commodity market indexes, all providing some clear-cut opportunities. We'll have a run through some of the key market drivers for this week. I hope you've had a good week. I hope you've managed to capitalize on some of the volatility that we have seen. Now, generally speaking, we continue the general risk on flow, certainly within the equity markets. If we focus towards the DAX here, we can see the DAX here on a daily chart just breaking through now and moving to all-time highs this week. Now, that's also been driven off the back of a largely more dovish ECB. We've seen a tilt from the ECB on considerably lower than expected inflation, and we're now pushing into the possibility of rate cuts coming into Q2, Q3, second half of next year, which is quite a big repositioning for the ECB, and interest rate probabilities have come back significantly since then, dropping lower, certainly driving a more dovish tilt in the Eurozone. Now, as a result of that, the DAX has led the way in the index space, and as we said, trading now back through its all-time highs and trading up here at 16,700. And also off the back of that, we've seen continued negativity in euro dollar, and euro just continuing to move to the downside. And for the time being, at least, no real reason for this trend to turn around. Clear persistence here, that dovish tilt from the Eurozone. Now, on the opposite side to that, we've seen some very, very dramatic moves out of Japan. We just have a look in here. So the Bank of Japan, whilst not actively going and raising rates, have started to make comments and allude to the fact that perhaps this could be coming. And Governor Ueda said policy management would become even more challenging from the year end and heading into next year, and flagged several options for what could come next. And this really opened up the opportunity which those bulls, those yen bulls, had been hoping for. And we've seen now a very, very aggressive move to the downside. We can see dollar yen here, significant sell-off, really accelerated yesterday. Now, if we come out to a higher time frame, this failure has come in at the exact same level that we saw previously when there was past central bank intervention from the Bank of Japan. So a big turning point here for the yen. It's going to pose a few potential challenges here. The Bank of Japan historically have always acted very late in terms of making amendments to their interest rates. They are potentially now going to be looking to raise rates as other central banks the world over start to cut rates. So that disparity between, for instance, the dollar or the euro and the yen going to become that central bank divergence, potentially going to become more extreme. That could pose some much larger downside here for dollar yen and for the likes of euro yen. Euro yen actually pairing that dovish sentiment along with strength from the Eurozone, creating strength from the Bank of Japan, creating a very, very significant move. Just look at this on a 4-hour chart, we can see that clear acceleration to the downside. The other school of thought here for the Bank of Japan is that they may have played a very, very clever card. They've been very, very patient. They have sort of ridden the storm. They've allowed the yen to weaken, and now they've put themselves in a position where perhaps the dovishness from other central banks will enable the yen to strengthen without the Bank of Japan having to aggressively go and hike rates. So they typically move in much smaller increments, 0.1% increments, 10 basis point increments, as opposed to 25 basis points of other central banks anyway. But if other central banks the world over become more dovish, as we are seeing with the euro, as we're likely to see with the dollar and the Fed, it may well be that the yen can gain the strength it needs without the central bank having to intervene too aggressively. So we'll wait and see how that plays out. But certainly for the time being, the potential for further downside in yen is most definitely there. This now creates a very large divergence between those two central banks. Oil in the commodity sector continues to tumble. Oil has had, as it says here, oil heads for 7-week decline for the first time in 5 years. Now, this week we had OPEC Plus meetings. They came out back at the start of the week. Those OPEC Plus meetings, there was a general desire from Saudi and Russia to look to cut outputs, but the cuts that were put in place were voluntary rather than mandatory, and that did little to support the oil market, which continues to move to the downside. And of course, supporting that move to the downside is the severe turndown that we're seeing in China at the moment. Chinese economy really struggling. Chinese equities have been hit heavily this week, and Chinese crude oil imports fell by 9% in November, whilst output is still holding above 13 million barrels per day. So still a pretty steady supply, and certainly some demand constraints here for oil, and that's just done nothing really but continue, therefore, this bigger, larger move to the downside. If we have a look at this on a daily time frame, we can see that pretty severe capitulation here now in oil. The next key support levels really coming in down towards the 67.50 handle. We're finding a little bit of support at $69, $70 a barrel here at the moment. So I wouldn't be too surprised to see a bit of a relief rally in this right now, but from a sort of a macro and a fundamental standpoint, there's no real reason for oil to suddenly start turning around, despite the risk on flows in equities. Little else really to give much confidence and much buoyancy here for oil. We'll of course be looking to see if there's any further developments from OPEC Plus and what's going to happen. Now, then the week came to a head. It was jobs day today. It was non-farm payrolls out of the US. The S&P 500, if we just pull that chart up, the benchmark index for the US has been in a holding pattern all week. We can just see this range which has developed, and we've just traded top to bottom of this yesterday, seeing a bit of a positive run back up towards the highs off the initial jobless claims data. But again, just holding steady. Market was then waiting to see what was the outcome of non-farm payrolls today to give a better indication of what happens next. That figure's come out, that print's come out at 199,000, prior of 150,000. Now that does little to change this consensus for this December meeting coming. So that's coming in next week on Wednesday, currently priced at 98% chance that we stay on hold with current rates, and a 2% chance for a 25 basis point hike. So that is little unchanged from where we were previous to this data. So this data of the 199,000 has done little to give us any clear direction. The initial response of that data was taken as marginally more hawkish. We saw some dollar strength, and we saw the equities, the indexes here and the S&P sell off. But since then, we have retraced all of those losses, and we're back trading pretty much where we were pre-data release. With little narrative here, the question to ask ourselves at this point, is there any reason for this market to take a turn, to move back to the downside? Is there any clear kind of real world headlines that support a move lower here? And for the time being, not too much. The data hasn't had the impact to do it. The European indexes still continue to move higher, and the narrative is still very much that the Fed are going to be looking to cut rates into 2024. So with the DAX going to all-time highs, the S&P in this holding pattern, and little new information for the market to digest, there's certainly the possibility that this market follows in the DAX's footsteps, breaks up through this 4,600 handle, and then perhaps we have a run up towards 4,700 in the week ahead. From a purely technical standpoint and from a profiling standpoint, there's a few elements here that are going to start to contradict that, and I'm just going to bring in, let's just bring in these profiles first and foremost, and just have a look and see what I mean by this. Just got the weekly profiles here. I've been keeping a close eye on these for the S&P, and just looking to see if we are likely to get any sort of meaningful turnaround. Sorry to get these loaded up. Okay, so here we can just see the weekly profiles. Let's just hide the price action for the time being. A few weeks back, off the back of the lower than expected inflation prints, we saw this big double distribution being created. Now that double distribution, point of control near the highs, most definitely suggesting some positivity and some growth out of the S&P, and of course we've stayed above the point of control, and we've persisted to keep making higher highs and higher lows week in, week out. But at some point, this double distribution is likely to come back to be filled in I've got to complete the auction process down through here at some point. So maybe we're looking at opportunities. When could we see this roll over and trade back down into there? Now, prior to this week, we had a V-shaped formation on volume profile and market profile, again, supporting some negativity. At the bottom of that V shape, we've also got these very, very significant poor lows, which we would expect the market to want to trade down and through again at some point in time. Should this market not see any sort of extension of its moves as we run into the weekend now, this market is going to close out as a balanced day or a balanced week. It's also going to be an inside week. We're going to finish trading the full trading week with inside the high and the low of the previous. Now, a nice balanced day like this, top of the trend, and inside day also supportive of reversals. So it may well be, I think, if this market does roll over and if we can break through the lows of this balanced week and the lows of this B shape from 2 weeks ago, that could be the catalyst we need to see this market unwind. And I think has potential to unwind quite quickly back down towards this 44.20 handle. Certainly the 4500s, back to these single prints which sit just beneath that. Of course, the counter argument to that is continued positivity, and we just get a continuation of trend. Either way, this market range bound for now. I don't think you can do anything particularly until you see breaks of one of those two levels. For me personally, favouring short, but if there's one thing I've learned over my years of trading, it's never to underestimate the strength of these indexes. When they get going, they are very difficult to slow down. And from a pure headlines and macro and fundamental perspective, there's absolutely nothing suggesting that this could turn around anytime soon. So it's purely a technical setup, but perhaps looks like there's some opportunities to the downside. But I'm never going to bet against these indexes. For now, we are still moving higher. The data doesn't change that, and perhaps next week we can see a further continuation and a continuation of the incredible gains that we saw in November. So as we draw to the end of the week, I think they're the major flows. Very much a hawkish stance out of the Bank of Japan, expecting continuing yen strength over the coming weeks and as we run into Christmas. The ECB turning largely more dovish and expecting, again, to see euro weakness. We're already seeing that filtering through the markets, and it's quite a significant sell-off in some of those euro pairs. Ongoing risk-on flows with the DAX moving towards some highs off the back of a dovish ECB, and little in the way of data and fundamentals to change the narrative here in the US either. Non-farm payrolls are not doing that. Oil continues to capitulate. OPEC Plus unable to stem the losses, and general slowdown and economic slowdown in China. A massive headwind here for oil prices. So we'll keep an eye on those trends. There have been very clear trends this week, great volatility. Hopefully you've had the opportunity to try and trade those markets. If not, never fear, they'll be there next week. As will we. Please do join us again for another weekly market insights next week, and our daily updates. Keep your eyes peeled for those. That's all for now, team. Have a lovely weekend, and we'll catch up with you all soon. Bye for now.